here. Today we're going to work on the Chapter 6 handout. I don't think we're going to finish. This is a really long handout. I think in the future I'm going to break it up into maybe 2 exams. But so we're going to finish the monetary unit sampling. We'll have a little more problem to do on that one, so we'll definitely get that one done. But we'll see what we get through on the Chapter 6 handout. And we'll see. Maybe we get it done. I don't know. Okay. So what we're going to do is, okay, looks like we got to page 4, maybe. Okay, so just to kind of rehash a little bit. So when we do our testing, we test assets that are the easiest to test. That's kind of what we build our audit around, is testing the assets and the liabilities. And getting a client is obviously very important. Now, from this point on, it's okay, we have the client, and so now what do we do? So starting with this one, the audit planning part, this is going to be, we have the client, we decided we're going to take the client on, and at least preliminarily they say yes. And generally you lay out how the audit's going to work in an engagement letter. And the engagement letter, you can read through here. Some of these are stuff we've already talked about, but you basically are trying to let the client know exactly what an audit is. And a lot of this stuff is stuff that we talked about before. Oops. You know, we have materiality, that's a judgment call. Reasonable assurance, that's a judgment call. And then there's inherent limitations, which we haven't talked about yet, but we'll talk about that in the internal control chapter. Well, I'll tell you what some of the inherent limitations. The inherent limitation is, like, let's say that you have an internal control set up, but the people aren't using it correctly. That would be an inherent limitation. It isn't that the control is bad, it's just that the way it's set up, that whoever is using it doesn't understand what the control actually is. And I've run into that a few times when I was doing auditing. I've actually done it myself. When I was a kid, I worked in a bicycle shop, and we were ringing up stuff, and the register that we were ringing them up on didn't print the receipt out very well, so we'd go to another register and ring the same sale up. We had no idea that it was a keeping track of whenever you rang up a sale. We didn't know it was a control. I think we were 14. I think back then you could get work when you're 14. But anyway, so it looked like the people were stealing from the cash register because they had all these sales, but they didn't have the cash to match it. And then one of the managers looked at the tapes and said, "Wait a minute, how come the exact same thing is being rung up for the exact same price on 3 different cash registers?" I'm like, "Well, the tape doesn't know it's printed." You can't do that. So anyway, but it was first of all, I shouldn't have 14-year-old kids who were using the cash register. But second of all, we didn't understand that it was a control, and that they expected to be in there. So that's a limitation of internal controls. That even though if you have a good internal control, that there could be things that, like mistakes that happen. It's a limitation of it. Okay, management's responsibility. This is one of those things that you have to really make clear, is that management has responsibility in the audit to give you all the information you need. And you can read through some of this other stuff. One of the interesting things is the staffing of it, and especially for large companies, internal auditors. This is what I was actually, an internal auditor. And a lot of times the external auditors rely heavily on the internal auditors. And for good reason. The internal auditors usually know the most about a company, especially their controls and all that kind of stuff. because they're there all year round. They're there, however many couple hundred days a year or whatever, they're there. So the external auditors, they show up for maybe 3 weeks. And so if they're looking at something like inventory, a lot of times they'll rely heavily on the internal auditors and say, okay, because the internal auditors may have 3 months to look at it, where they have 3 days. So the internal auditors are often used quite a bit. I was an internal auditor for Navistar and U.S. Steel. Navistar makes trucks, but anyway, and for both those groups, where our auditors were Deloitte Touche, and so Deloitte Touche I would work with them all the time. That and whenever we had reports, we'd make a copy and send it to Deloitte Touche. So the internal auditors actually are relied upon pretty heavily for large companies to help with the audit. And I'd also do work with them. Okay, now suppose that this is the first audit that is being done on the client. Okay, so they give you the income statement. It looks like this. That's a little messed up. But anyway, so the problem here is this inventory. So here it is at year end. And we're supposed to verify all these numbers, right? Because here's the goods that are available, and either we sold them or we still have them in inventory. So sending inventory is important. But there's one number on here that we probably cannot get at year end. What is it? Out of all these numbers here, which one is going to be really difficult to verify at year end? Wow. I'll give you choices. Which one's going to be the hardest to verify? You can put in chat if you want. The beginning inventory, the purchases, or the ending inventory? Which one is going to be hard to?
Would it be the purchases?
Purchases actually be the second hardest to do. The first hardest to do would be this one.
Oh, okay.
Inventory. And here's the reason why. Unless you just happen to do an audit of just the inventory at the beginning of the year, this number is going to be hard to verify. So the beginning inventory is probably the one that you're going to have the most trouble with. And notice, if you don't know what the beginning inventory is, you don't know the goods available. If you don't know the goods available, you don't know the cost of goods sold, you don't know the gross margin, you don't know the net income, blah, blah, blah. Okay, so the first year, the beginning inventory is the problem. So let's highlight this. So this one is the problem. Yeah, and we can't jump in the time machine and go back and verify it. Okay. So let's say that now, if the inventory is not material, it could be that it's not material. They don't sell very much stuff. Maybe they do more service work or something, so it might not be material. But in this case, it looks like it probably is, because the sales are 5,000 and 4,000 of that is cost of goods sold. So, okay. Now here is where it can be a little bit tricky. And that is, if which opinions are appropriate if the material account balance cannot be verified. So if you can't verify an account, what kind of opinion do they usually get? Or actually, that's kind of a I have that written a little bit funny, but what kind of opinion are they going to get if they have if you can't verify something in this material? Now, notice that you don't know if this is misstated or not, right? I mean, this beginning of inventory might be, right on, but you don't know that. You can't verify it. So which opinion would you do? You put it in chat if you want.
Is it adverse?
Probably it would be a disclaimer. An adverse means that you, disclaimer. Yes. Adverse means that you know that something's wrong. This one you really don't know. I mean, it could be that the inventory is wrong, but it also could be that it's okay. So notice that there's a built-in problem for the first year of doing an audit. Now, it would be good to tell the client, and I'm sure this would come up, that look, the first year you have you give a material amount of inventory. So the first year, if you want, we can just come in and do an audit of the inventory, and then next year give you a complete audit if that's what you want. Because there's this, you're going to get a disclaimer the first year because we don't know what your beginning inventory was. If you're called in a year ahead of time and you can just come in and verify the inventory or just the inventory, then you can come back and do a full audit the next year. But if that's not the case, you have to tell the client, look, it's likely you're going to get a disclaimer. Now, there is a little bit of a loophole. And this loophole comes from the phrase, statements taken as a whole. And this taken as a whole has been interpreted as being two different ways. It could be all the financial statements, in which case you would give a disclaimer on all of them, all four of the financial statements. It could be that you could also do it for individual ones. And for the individual ones, you could get a disclaimer on the income statement because you don't know what the income is, you don't know what the inventory is. Statement of retained earnings, the income goes into the statement of retained earnings, so that one would get a disclaimer. The balance sheet is everything is at year end. You could actually give an unmodified opinion on the balance sheet. And the statement of cash flows works into the income statement. So here's the thing. You could separate them out. You could give four different opinions: a disclaimer on the income statement, disclaimer on the retained earnings, disclaimer on the cash flow, but give a clean opinion on the balance sheet because everything is going to be at year end. This ending inventory, you verified that. So that's going to be on the income, it's going to be on the balance sheet. So, the stuff at year end, this is all, let me write that in. Because all this is at year end. That's not how you spell year, in case you're wondering. And that's not. Okay. Because this is all at year end, you can give an unmodified opinion on it. Now, and you might say, well, okay, well, so what? We got disclaimers on these other ones. But yes, but at least the client can now go into the bank and say, yeah, there's a disclaimer on these other ones, but this balance sheet, all of the cash, the inventory, the equipment, the liabilities, all that is okay. So it is you are giving them something. You're giving them, a disclaimer is basically nothing. Here's a disclaimer. We don't know. It's a shrug. Here's the bill. So the nice thing about being able to split the opinion up into each of the individual ones is that you can at least give them a clean bill of health on the balance sheet. And that way, again, they can go to the bank or investors and say, yeah, this is a disclaimer, and you can explain why. Actually, it'll be in the disclaimer report as to why. But you can go and say, look, with the balance sheet, all of our assets, liabilities, all that kind of stuff is all in order. And notice that if the assets and liabilities are in order, that means the equity section is also in order. So you're giving them something, and you're giving them something that they can actually take to the other people and say, look, this has been verified. The other ones haven't. Next year we'll get those verified too, but right now this is it. So this is a good thing for the client. And again, it's not that you're their buddies, but that you do want to give them everything that they have earned, so to speak. And if their balance sheet is fine, then give an unmodified on it. Clean opinion. Okay. The audit plan is a detailed, I should highlight that. High-level description, nature, timing, extent of all the procedures. And this is one thing that you gotta realize for auditing. You go through this auditing class, man, I could never remember all that stuff. I can't remember all that stuff. You go through, for instance, chapter 10 of this textbook has a bunch of stuff on the cash account. And there's about 10 things in the cash account, 10 kind of important things that you gotta, man, I never remembered all that, right? Well, you don't have to. They have, once you get the client and once you start going through and planning the audit, you're going to come up with the audit plan that's going to have the procedures, all the detailed. And a lot of these, if it's happened for more than 1 year, you'll have last year's ones. But you can also look these up on the internet and stuff. You'll find people that have audit plans for auditing cash, audit plans for auditing accounts receivable, inventory, and all that kind of stuff. My point being is that it's almost like baking a cake. If you follow the recipe, you're going to end up with a cake. It's the same kind of thing. As long as you go through the audit plan and do everything you're supposed to do on the audit plan, you'll come up with either problems or that you corroborate what the client has. So, for instance, when I was doing auditing, I came up with a bunch of stuff that you find that was wrong. It wasn't that I was just so smart that I came up with all this stuff. You just follow the audit plan. And you verify this compared to this, and there's a discrepancy here. This is a problem, and that's what and that's what I would report on, is that problem. But again, it wasn't this that I was just like so amazingly smart. If you follow the audit plan, it'll usually get you there. So following the audit plan is really, important. And again, it isn't like we do this, brand new every time. Now, you will have different audits for different clients. Every client is different. There's no such thing as an ordinary cat. I think I told you guys that before. Maybe I didn't, but that's my favorite fortune cookie saying. There's no such thing as an ordinary cat. Every cat is different. They're different colors, different sizes, different everything. So same thing with clients. And, Target is different than Walmart, is different than, Kohl's is different than whatever. So these are all, everyone's going to have a different audit plan. Okay, so the first thing we do is we look for risks. What could go wrong? Okay, so looking for what could go wrong, and I think we talked about this later. I'm sorry, I'm jumping ahead here. Yeah, I do put that in later. I'll be quiet on that one for now. Okay, so what could go wrong? What are the things that we have to most worry about? Then we go to audit procedures. We'll design audit procedures to find those risks. Now, if we're doing an audit report from the previous year, we may already have those procedures set up. If there's something new that comes up, we'll maybe make new procedures. So figure out what the risks are, make audit procedures to come up with them, and then other procedures to comply with the standards, which we'll talk about later. Okay, so, and by the way, here. The tentative audit plan is developed based on the auditor's initial risk assessments. Plan may require frequent modifications as the audit progresses. So again, when things come up, we'll react appropriately. We might have something that we think is a risk, and as we start looking into it, it's not a risk at all. Okay, we're not going to waste a lot of time on this because this isn't a problem. On the other hand, there might be other things that pop up that wait, where did this come from? We got to look into that. So an audit is not set in stone, the audit plan, and it will alter based on what you find. And if you find problems, you're going to go and search more, look more into it. And on the other hand, if you come up with things that are not a problem, you're not going to waste a lot of time on those because it's not, just to follow the audit plan for things that are not going to be a problem or not a risk would be a waste of time and clients' money. Okay, so they will modify it as it goes on. Okay, so which of the following characteristics? The audit plan, is it general in nature? Nope. It's detailed. So it is not general in nature. Yeah, let's make it a different color. How about green? No. Is a detailed list of audit procedures? Yes. There'll be very specific procedures, what you're going to need to do, and as an auditor, you will follow those things. And as you get used to doing audits, you may alter them a little bit and tweak them a little bit as you go on. Can be changed once the audit is started. Yes or no? You put it in chat if you want. So can we change the audit? We start the audit. Can we change it? The plans? Okay, I'll give you this one. Yes, we can. So yeah, if you come up with a problem, you can definitely look into it. You do not have to follow it verbatim. It's obviously good to follow it as much as you need to, but at the same time, you can make adjustments. Is based on risk assessments? Yes. Everything we do is based on that audit report and whether it's things are materially misstated or not. The same for all clients? Ooh. And maybe revise, we kind of talked about that, yes. Okay, so this is, that's right, yes. So yeah, so this kind of audit is not general, it's very specific in nature. It's detailed. It can be changed based on new information about risks. So when you revise the risk assessment up or down, it could be something that was a risk last year that's not a risk this year, or it could be something a new risk or something like that. So it isn't that these are set in stone and you can't change them. You certainly can. You're going to do all the procedures you need to address all the risks, but at the same time, you're not going to waste time, and you're also going to hit all the risks that you think you need to hit. Okay. Assessing auditor, understanding of the client and its business. This is required. You are required to get an understanding of the client, of how they do business and of the business that they're in. A company that grows flowers will have different risks than a company that sells fireworks or something, so what their business is also very important. You're going to find, so what you get an understanding of the client and what kind of business they're in is important so that you can understand what the risks are. Inquiries. One of the weird things about auditing that doesn't seem as good of evidence, but actually is talking to people. So asking management, how do they do this? How do they do that? Analytical procedures, which we'll do later. We'll do one later on today. We'll hold off on this one. Observation and inspection. The one there that might inspection, I imagine you guys, most people think about auditing is inspecting documents, but a big part of it is watching people what they do, and especially when you're trying to get a feel for how the procedure and how they're doing the internal control procedures and things like that. One of the things I found that was very eye opening when I started auditing. And first of all, I started, like anyone, you started out, you're brand new, right? I was brand new. And I'd be in these audits, and it became very apparent very quickly. Here I'm at this, these companies that have people that have been working there for 15, 20, 30 years. And I think, okay, these people are going to know everything. They're going to know everything about everything, right? I mean, they've been there for years. They're going to know. What I found out was very eye-opening, in that most people don't think that way. They don't think like auditors. They don't. If someone tells them to do this, they go, okay, and they do that. They may not understand what they're even really doing or why. And sometimes you have people that don't understand it, and they quit doing it. Well, I don't know why I'm doing this. So you really get this like it's just we have a different view. As auditors, you have a different view than normal people than the people working in a company. Most people, they give them their job, they tell them that, we want this, and this, and they do it, and that's as far as it goes. I remember writing up for internal controls, talking to someone about internal controls. This guy was a high level accounting, and he said, "Oh, well, what do we do?" You've been here 20 years. I've been here 2 months. You're asking me, but you realize that they don't think that way. So you had to really come up with, what when I was doing the audit, what you need. Here's what you need to do. Basically, and you're always worried about putting that out there, because notice that there could be a problem of bias, basically, or that if you tell them to do something, the next year when you go there, they'll say that control you told us to do. Even if they're doing it wrong or something like that, it can come back on you, and that you want to be objective about it. So ideally, the client should come up with a control to fix for it. So you say, okay, here's a control problem, and you ask the client to come up with a fix for it. Now, if they can't, or they honestly don't know, you generally are stuck in that place where you can't tell them you should be doing this, in broad terms. You would not say specifically who does what and all that kind of stuff, but in broad terms, you can certainly explain to them what they need to do. Internal controls are really confusing for a lot of people, and so you will find a lot of times that when you observe them doing things, that it's very different than what they're supposed to be doing, or it's very different than what other people think they're doing. Okay, other procedures, people outside the company, we'll talk about those later. External sources, we'll talk about that later too. So this is all stuff inside the company. This is outside the company. Okay. Analytical procedures. Analytical procedures are, you're basically looking for relationships between data. I know that's kind of vague, but that's what it is. Oftentimes they're ratios, and you guys have worked with ratios in your other classes, so current ratio, quick ratio, all that kind of stuff. And you look at these ratios and do the analytical relationships. You're looking for things that are plausible. So plausible relationships. This is a you look for relationships between. Okay, so let's take a look at sales. Down here we have sales and we have advertising expense. Other than this being from 2 years ago, what's unusual about these analytical procedures? So let's say you get this from a client, they have their 2022 sales and 2021 sales, and they have advertising expense for 2021 and 2022. What's odd about this data that they gave you? What's odd about this? You put it in chat.
That they wasted less on advertising in 2022, but they made more.
Yeah, usually, yeah, exactly. As sales go up, usually your expenses, especially advertising expense, goes up. How did you sell more items? Like advertise more, or pay more commissions, if nothing else. That people are, the more they sell, the more commissions they get. You would expect that an increase in sales would have an increase in advertising expense. Okay, so the unusual thing is that sales increased. So what's unusual about the information? Sales increased while advertising expense decreased. Just like what you said. So that's unusual. Okay, now let's take a second here. Is this proof of fraud?
I wouldn't say it's proof.
I'm sorry?
I said I wouldn't say it was proof.
No, it's not. It's not proof. It could just be they found a better way to sell stuff, and they do it more cheaply. There are explanations that don't point to fraud. However, you're going to want to investigate this because it is unusual. Usually, as sales go up, usually all expenses go up, but certainly the advertising expense you would expect to go up. So, what is a risk that should be investigated? There's actually two. It could be that one of these is wrong. So, for instance, it could be the advertising expense is too low. Could be the advertising expense is understated. That's one of the risks of this. What could be another risk of it? The problem might not be in advertising, it might be in what?
Sales.
Yeah. That's not how you spell sales. Could be the sales are overstated. Maybe they did something to the sales to make them look higher, even though their advertising expenses dropped, and maybe their sales have decreased or something. But so these are the two things that you're going to investigate. Now, again, it could just be that these things just happen sometimes. They find a better way to do something, or sales increase for something completely unrelated to advertising. COVID hits or something. It could be all kinds of things that could happen, but these are the risks you're going to want to investigate. Are the advertising expenses too low, or are the sales too high? That would make for this unusual relationship to occur. Okay. Let's take a look at risk analysis. So this is when you're actually looking at a risk, and we always look at risks with the idea of a dollar amount and a probability. So notice we have a dollar amount here. But we also have a probability that these things are going to happen. So what we're going to do is figure out which one of these are really going to be the ones that we're going to focus on. Which is the greatest concern for the auditor? Okay, so what we're going to do is multiply them. Okay, okay, so 1% of 5 million, 50,000? I think that's right. 40% of 400,000 is 160. Oops. And 80% of this one, so this will be 4,000. Oops. All right, so which one is a greater concern for the auditors? Did I do this one right? Yeah. Okay. So which one are we going to be more concerned about?
Risk B.
Yeah, risk B is definitely what we're going to look at here. And notice that even though it's not, the dollar amount isn't the highest, we always have to frame it within the terms of what's the probability of it. You know, there's a 1% chance this is going to happen, fairly rare, right? You know, once in 100 years. Whereas this one is kind of likely. You know, it's almost a flip of a coin whether this one's going to happen. So this one is pretty much a concern. It's also a very high dollar probable amount on there. The one with the highest probability is risk C, but what's the problem with risk C? It's probably immaterial anyways, right? Especially when you have a $5 million hanging out there. The risk of this is off by 4,000 is probably not a material amount. Even if it was 5,000, if it was 100%, it wouldn't be that big of an amount. So risk B is the one that we would focus on for this. It's fairly likely and it's a fairly high amount, at least relative to the other risks that we have here. So we don't just go by the risk for the dollar amount. It's always there's this probability part to it. Okay. I goofed up my spacing here somehow. Let me back up. Okay. Qualitative considerations of material miscellaneous type, which of the following characteristics? These are for dollar amounts only. So how many dollars is it? For the materiality. And we'll see on the next page what I'm talking about. So you're trying to determine what's material. And, you know, is $10,000 material or is it immaterial and that sort of thing. And we'll figure out how we kind of come up with those ideas in a second here. Now, there are things called qualitative considerations. And these are qualitative considerations that may make something material even though it's not dollar-wise material. So because it's not dollar material, it doesn't mean that it isn't material at all. It could be that these qualitative things. Okay, so this goes to the nature. The nature of the misstatement. What it is makes a difference. What the misstatement is. Okay, so if it's a misstatement, let's say that it's not material dollar-wise. Let's say it's $10,000, and we say, okay, $10,000 is not material. It could be material if it violates a contract. A loan agreement, government contract. These are all things that could make it material, even if it isn't. So let's take a loan agreement. A lot of times when you take money out from a bank, you get a bank to loan you money. They want to protect their interest, right? So they'll loan you the money, but they'll say, look, you have to do all your financing through us. You cannot go somewhere else. And that's very common. What they don't want you to do is to go around to 5 different banks and get loan agreements, 5 different banks, and they don't know. 5 different banks may all think that they have collateral out, for the inventory, whereas actually you got 5 different groups, and it's going to be a legal fight if anything goes wrong and all that kind of stuff. So they'll say, look, part of our part of this is that you only get financing from us. Suppose you have a client that has one of those agreements and goes somewhere else to get financing. Okay, maybe even if it's not material, maybe this is for a small amount or whatever. If it's in violation of that contract, notice that the bank is probably going to look at those financial statements and want to know whether they're in compliance with their loan agreement. And so they may be relying on that audit to let them know whether they are or not. And if it's in violation of their loan agreement, it's up to the auditors to say, okay, that is material. Even though $10,000 may not be material dollar-wise to the company, it could be material because they're violating a contract, and there's going to be people looking at this audit report to see if they are in violation of that contract. Okay, reverses the trend. This kind of goes into the next one too. Changes a loss to a gain or vice versa. If it has to do with management fraud. So again, let's say that you find a fraud for $10,000. It's not material. It depends on who's doing it. Someone in the shipping department's doing this fraud. It's $10,000. It's not material. You're probably not too worried about it. If it's a chief financial officer that's doing this fraud for $10,000, okay, chief financial officer is someone you have to rely on. And if they're being dishonest, if they're being, doing fraudulent things, it means you really can't trust them. And at that point, it becomes material because now you're questioning. It's a much larger net now because of who's doing it. So anytime upper management's involved in anything like fraud, it becomes material, even if the dollar amount maybe isn't. $10,000, shipping supervisor, $10,000, not material. Chief financial officer, $10,000, material. So who's doing it makes a difference. Increased management compensation. Sorry about that. I just sneezed. All right. So we'll do this and then we'll take a break. Okay, so quantitative materiality. This is for dollar amounts. I mean, this is usually what we think about when we think about materiality. How many dollars is it to be material? This is all judgment, but they do have rules of thumb, and different CPA firms will have their own rules of thumb that they use. And it's up to the auditors, for these rules of thumb, they may choose any of them they want. They may choose more than one. They may get kind of a blended materiality, but they can use any of these they want. Again, this is judgment. It's judgment to determine which ones you're going to use. Okay, now let's take the first one. I think is the one we concentrate on for this example. Okay, so income before income taxes, they give a percentage that it could be between 5 and 10% to be material dollar wise. And I got this in decimals too. I don't need that, but okay. So 5 to 10%. Now notice something. 10% is twice as much as 5, right? So if you're looking at dollar amounts, it could be 50,000 or 100,000. The question is, well, which one do you use and when? Okay, I'm back. The percentage is inverse to the client size. So in other words, we let smaller clients have the higher percentage, and I'll show you why in a second. And the larger ones, we hold them to a smaller percentage. So it's inverse, this client size. So small clients get the higher percentage. Larger clients will get the smaller percentage. And we'll see how this works out. All right, so let's take the first one here. Smaller client, income is 150,000. Not bad income, but not huge dollar amounts. So for a small client, are we going to take the 5% or the 10% most likely? I think I may have confused people here. Okay, we're going to take the larger percentage. And I'll show you why. It's because the actual dollar amounts in total are usually not that big because it's not as big of a company. So you might allow a smaller company to have to use 10%. Say, okay, we'll count 15,000 as big material. Notice that is $15,000. You're probably not going to get sued over that, right? So a lawsuit probably costs more than $15,000. So the smaller companies, because the dollar amounts are smaller, you can give them more leeway percentage wise. So okay, well, yeah, we can take up to 10% on this because, again, it isn't. These are astronomical dollars. It's only going to be $15,000. We're not talking about millions or anything like that. So we'll allow them to have the higher percentage that it will that it could be misstated by, simply because the dollars are not as much. Okay, let's take the other extreme. Let's go to company C. Company C, we have income before taxes of 1.5 billion. Okay, are we gonna use 5% or 10% for them most likely?
I guess 5%.
Yeah, it's really big. These are big company. This is a big, and so just the dollar amounts at 5% are going to be probably not going to fit on that screen here. $75 million. Is that right? Yeah. Okay, so we're going to hold them to a tighter percentage wise. Oh, because this comes out to 75 million, people will sue you for 75 million. Okay, now here's where so those two are kind of, if you're using that rule of thumb, they're kind of cut and dry. Let's go to Company B. Company B is not massive, but it's not small either. So we have a judgment to make. Oops. What percentage are we going to use? And again, this is a judgment, so there's no right or wrong, but probably somewhere in between 5 to 10. So what would be a reasonable percentage, say, for this medium-sized company? By the way, there's no right or wrong answer as long as it's between 5 and 10. We're not expecting a. Let's see, in the chat. Yeah, 7. So you might say, okay, again, this is not a small company, but it's not massive either. So we'll go in the middle somewhere. Again, this is judgment. It's a judgment as to what is material. We have a rule of thumb, but that does not necessarily mean that it's there's no judgment involved. 3.5 million. All right, so for this one, maybe we go, 7%. Do that right? Yeah, that'd be right. Because 10% would be 5 million. So yeah, I guess. Okay, so again, this is when we look at the dollar amounts. So the dollar amounts of these is what we're looking at. Okay, we'll do one more thing down here for quantitative. This is something that kind of came up within the last, I don't know, maybe like last 5 years has really become kind of part of the mainstream. Performance materiality. And that's the term they use. That's not one that I made up. And performance materiality is sort of like this. Okay, you come up with this overall, 3.5 million or whatever for materiality. Okay, this is what's going to be material. Now the question is, for each account, how do you, what's allowed for each account? You're not going to allow each account to be off by 3.5 million. They may not even have 3.5 million and allow the account. So the question is, how do you divvy it up? When are you going to get excited about an account being stated for each account? So what they do is they'll take this total materiality and they'll split it up, and they call this performance. So when you're performing the audit, what's material? And you'll do it generally by account. So what's material to this account? Cash, inventory, accounts receivable, accounts payable, whatever it is. And so you take it and you split it up amongst other accounts. So that's what we're kind of looking at here, is how do you split up that materiality for performing the audit? And I'm just going to make up these numbers. Cash is kind of an important account, so let's say that we're going to make sure that that's within, 10,000. So oops, I left off a 0. So maybe of that 200,000, we're going to have 10,000 go to cash. We're also going to have some of that go to accounts receivable and some of it go to inventory. Okay, so we still have what, 190,000 left? How much do we want to go to accounts receivable? Some number between 0 and 190,000. 100,000. Yep, good. Okay, so let's say that we go 100,000 to accounts receivable. And so we would have, what would that leave for inventory? 90? It's 90. So what we've done, we've taken this overall materiality and we split it up into the performance materiality. And the performance is, so now, so if, if you're doing a cash account, your materiality is going to be 10,000. If you're doing the accounts receivable account, it's going to be 100,000 inventory. So you will know what is material and what's not material as far as each of those accounts is concerned. So it's kind of splitting up this overall materiality into what they call performance materiality. In sampling, we call that the tolerable misstatement. Let me write that in. So in sampling terminology, we call that the tolerable misstatement. So each account, so what was the tolerable misstatement for cash? What's a tolerable misstatement for accounts receivable and so on and so forth? Okay, let's stop here. And we will come back and do, I think we just got one more problem on here to do. Where's my cursor? Oh. Let's say be back at 308. And we'll do this last one, and we'll be done with this handout, so then this can be turned in today. Okay. What's wrong here? Okay, let's go ahead and go through monitor unit sampling. All right, so this is the account we're looking at. The risk of incorrect acceptance is 10%. That's a judgment call we came up with. The book value of the receivable is $2 million. The interval is 100,000. Here's a question: how many items were in our sample? The book value is 2 million, and we have an interval of 100,000. How many items were in our sample? Maybe something like a multiple choice question on the CPA exam with that. Anyone? What would be our sample size if the interval is 100,000? You can put it in chat if you want. No one? All right. Well, let's go ahead and get started then. So let's go to the first one here. Is actually an unusual one. And what's unusual about this one? You've already left, haven't you? You're sleeping.
So just that the audit value is higher than the book value?
Yeah, this is an understatement. That's not how you spell understatement. This is an understatement. We don't do anything with this. This method is not meant to detect understatements, and when we do find one, we ignore it. Kind of like if you went fishing and you caught you pulled in an old boot or something, you'd throw it back. Well, you shouldn't throw it back; throw it in the garbage. But anyway, it's an understatement. We're not supposed to find it. This actually would not be any mistake. So we're only looking for overstatements. Okay, like this one. This is an overstatement. We said it's 15,000. They say it's 20. Okay, so this one we can multiply out. Ouch. So 15,000 divided by 20,000. Okay, so the projected value of this is around 75,000. And the projected misstatement is 25,000. All right. This one has also got a wacky problem. What's wacky about this one? The one thing that's wacky about this one is that the book value is greater than the interval. So this would be 100% sure that we would catch this one because it's 100% sure it's going to get caught. It covers an entire interval. It may even cover 2 intervals. So we're 100% sure it's going to get caught. Now, when we find these, we go to the actual misstatement. So we're going to take the 108,000 minus the 95,000. This will be the actual misstatement. So 108,000 minus 95,000 equals 13,000. So this is the actual misstatement. This is what we're going to put in over here. Now, the wackiness for this one is not over because we have this incremental allowance. Okay. And just to kind of refresh your memory, incremental allowance means there's something else that could go wrong in that interval. You know, if you find an error, that means there could be more errors in that interval. The problem with the one that we just did is that it covers the entire interval. There could be nothing else wrong in that interval. It covers the entire interval. So it's not going to be in the incremental allowance. You know, that interval that's completely covered, nothing else could be wrong in it. You know, the actual that is off by is 13,000. It can't be any more than 13,000. So incremental allowance for the first one, well, it wouldn't matter anyways, but no, because it's not a misstatement. The second one, yeah, it could be. There could be more because there could be more things wrong in that interval. You know, we've got 20,000 and 100,000 here, so there could be more things that are wrong in here. You know, this only covers 20,000. There's another 80,000 that could be, you know, misstated as far as the book value is concerned. So there could be more things wrong in that interval. So incremental allowance, yes. And this one, even though there is a misstatement, it cannot be in the incremental because there's nothing else available in that interval. The entire interval is covered. So our protected misstatement will be 0 plus 25 plus 13 is 38,000. And this is our best estimate is what this is off by. Okay, so it's kind of like this as far as if we're kind of looking at it statistics wise, it kind of look like this. Let's see here. Well, okay, so they say that this account is worth 2 million. Our best estimate is that it's off by 38,000. Okay, now, so, and those are just kind of what we came up with. Now, it could be off even more. You know, this is a sample, so it's a one-tailed sample, by the way. So this could be off even more, you know, because it's a sample, right? If we did 100%, we could come up with exactly what it's off by, but we did a sample, so it's possible it could be off by even more. And so this is what we're going to use to find our upper limit. Okay, so let's go back. Okay, So basic precision. On the test, I'll put this in an easier place to use. Okay, basic precision. Equals our interval times reliability factor. Okay, so our interval is, I'm gonna put it right in here. Our interval is 100,000. Times our reliability factor. Now this is at 10%. Okay, so reliability factor, 0, 10%, 2.31. Did I get that right? No, I didn't. 2.31. Okay, so what is that? 231,000, right? So our basic precision is 231,000. Now, the basic precision is if there were no misstatements. So this is under the assumption there's no, so even if there are no misstatements, it's still possible this could be off by more. And so it kind of looks like this. It could be off by another 239,000. So this is the basic precision. That's precision. Man, do I write bad. So basic precision, it could be off by another 231,000. So this is the projected. Should give myself a little more room here. And this is our best estimate, but it could be off by another 231,000 because of basic precision. And we could have an incremental allowance, which we'll do last here. And this is the wacky one. This is the most wacky one. Now we only have one that we need to do it for, so we'll just do it for the 25,000. Incremental allowance. Let me make that into blue so that we know. Okay, so coming down here, this is where it gets strange. So at 10%, we have overstatement at 1. Minus overstatement at 0. Minus 1. And yes, we should just have a table for that, but 0.58. So this is our factor, incremental factor. We are going to plug in the only loss we have. It's the largest one, but it's also the only one. So 25,000 times 0.58, whatever that is. 14,000, is that right? 14,500. So that is our incremental allowance. We're saying that this could actually be off by a little bit more because we have misstatements. Hey, why is that small? Okay, so our calculated incremental allowance is 20,500. All right, so what we're saying is that 90%, that this is the incremental allowance. It could be off by another 14,000. Okay, so this is our best estimate. Basic precision is that, so you can't read it. 231,000, and then it could also be off by 40. So we're going to add all of these up because this is the total amount that it could be off by. 38 plus that will tell us the total. That's the upper limit. And I'm going to get all these. So all of these together will come up with our upper limit. Oops. Whatever that is. $283,500. So this would be our upper limit on misstatement. Ah. So this could be off by as much as 283,500. This would be the upper limit. So Our best estimate, it's off by 38,000. However, this is a sample, so it could be off by as much as 283,500. So this is what you determine whether it's material or not. $2 million, I'm assuming that is material, but whatever it is, it's a judgment call. But so 283,000 is the upper limit on the materiality for that. Oops. Okay, so that's D. Okay. Advantages and disadvantages. We talked about some of these. If they have a low occurrence of misstatements, a smaller sample size, and this is one of the big advantages of it. A smaller sample size is needed. Automatic stratification of the sample. In other words, we get larger dollar amount items are picked automatically. And I should not have that in capitals. And this is the ideal this is one of the huge advantages of it, and that is that it at a certain point, that's not me. At a certain point, the larger that they start cooking the books, the more likely it's going to get caught. So it automatically picks those larger items that are more interesting. You're more interested in something that is 50,000 than something that's $5. So it automatically will pick those things. If you take a random sample, the $5 item and the $50,000 item will have an equal chance of being picked. If you do this kind of sampling, it automatically the $50,000 one is more likely to be picked than the $5 one, just because of the way we pick them from going through the intervals. And you wouldn't know it by doing it today, but if you get into doing this, it's easier to use in the classical sampling. And one thing about the classical sampling and actually I've used that I've used both of those. The classical sampling I actually use more than the monetary unit sampling. But the classical sampling, they generally have you pick really large sample sizes. And as you're going through these, you pick a sample that's 103 items. By the time you get to item 40, you know where it's going, good or bad. You go through 40 items, you haven't found anything. You keep going. I mean, obviously you do the entire sample, but usually by the time you get, way before you get to the number that you got to get for the classical sampling, you pretty much know where it's going. It's always been the case. You get to the item number 40 and there's 12 of them are messed up. You go, okay, this is, I know where this is going. At the same time, you get to 40 and there's nothing wrong. You say, okay, I know where this is going also. So a lot of times you're going through when you're actually doing the testing, for classical sampling, a lot of times you will find that, just intuitively, when there's going to be a problem or not. Okay, disadvantages. Cannot be used for understatement. This is the big problem with it. If you think there's an understatement, you can't use this method. This method ignores them. It ignores them with the fact that it doesn't even count them at all as a misstatement. And this is another big problem, is that the sample size is not easily expanded. If you're doing classical sampling, you can take a larger sample, and if the items are picked randomly, that's fine too. Notice there's a problem with expanding the sample size for a monetary unit. If you pick a bigger sample size, that means the interval changes. the items you pick will change. So it's not like, okay, we can go grab some more and be a little more sure. Let's say we're at the 95% level. Let's get to the 99% level and see if this is still misstated or whatever. You can't do that with probability proportional size. You go to the 95% level, you're going to pick all different items. Maybe not all different items, but you're going to pick different items because you pick them based on the interval. Classical sampling. If they have a bunch of errors, you get a smaller sample size, and it has no problem with those. This one's kind of a wacky one. Negative items require special consideration. I would say negative balance ones would. A lot of times, if they're negative balance, it means that they're misclassified. So, for instance, if you have a negative balance in accounts receivable, that really means it's an accounts payable, right? If you owe the client, if you owe one of your customers $500, that's a liability. It's not a negative asset. But we'll skip that one for now. Can be used. This is the important part. Can be used for understatements and overstatements, and if you're not sure, this is the method to use. The classical sampling, and the size can be easily expanded. If you're at 95% level, you want to go to the 99% level, you can do that. Go through the formula, tell you how many more you have to pick those randomly, and all of a sudden you're at 99% level. Disadvantages: estimated standard deviation must be determined before you pick your sample, which is kind of counterintuitive. You got to take a sample of the sample sometimes. And stratification may be needed. We'll talk about more about that later. The auditing standards do not advocate one technique over the other. They're simply used in different circumstances. Back in the wacky old days that I grew up in, they would talk about probability proportional size as being the perfect sampling. This is the one you should be using if you can. And they've really toned that down. They said, no, it depends on your sample, whichever one you should pick. That even though monetary unit sampling, monetary unit sampling is specific for auditing, does not mean it's better in all situations. Certainly, for understatements, it's no good at all. So you really have to choose and pick and choose which ones you're gonna use. The big things are, though, is that for monetary unit sampling is that things like sales, things that people would cheat on, those are more likely to be picked. They're more likely to be overstated. And when it comes to auditing, you generally don't get sued if the company's doing worse than they say. If the company says that they're doing better than they actually are, you can get sued for that. So if the company says that we had sales of $10 million and they really had sales of $9 million, you can get sued for that. Why did you guys miss this? It's materially misstated. Okay. You generally don't get sued the other way around. If the company's doing better, a bank saying that, the bank's not going to sue you for if their sales instead of being $10 million were actually $11 million. All that means is the bank's collateral is more secure. That is really, they don't have a lawsuit there, basically. So you generally are looking more towards the company doing worse as far as lawsuits are concerned. So things that are overstated that you might worry about more than being understated, things like sales. Things like inventory, those are the kinds of things that it would be good for this method, the monetary unit sampling, is that those things that are more likely to be overstated and to try to make themselves look better, a company. And again, you generally, if the company is doing better than they say they are, you generally don't get sued for that. There's very little. I guess someone could sue saying that, gee, I thought the company was doing worse, so I sold my shares of it or whatever. But it's very rare to have that that occur. Okay, so we can turn that one in, and I am going to do something here. I'm going to give you guys extra credit for being here. Don't leave yet. And I'll add this. So there'll be extra credit on the next one for the multiple choice questions, but I want to give you guys Kaylin, Enrico, and Giovanna. Okay, and next week we'll finish up the chapter 6 handout, and we'll do the multiple choice. But we also have one more statistics handout that we'll probably get started on. But yeah, so we'll probably start on that next week. So, but certainly we're going to hopefully get through I say hopefully, we will get through the chapter 6 handout next week, and then we'll have the exam. Okay, any questions? All right, well, thanks for hanging around, guys, and I will see you in a week's time.
Thank you.
Thanks.